Hello, friends. Good evening to the people in India. Good morning to people in US. Good afternoon to people in Europe. I think we have people all around the world. So today, in our weekly webinar series, we will be discussing about the due diligence process from the startup. And when startup goes through the funding round, this is the most critical step which they go through it. And to discuss this, we have a illustrated panel today. Just to introduce the panel, we have a Prachi Agrawal. She's from iExamB. She has been associated with startup funding. Recently, iExamB concluded the big round of 10 crore rupees, and she was associated with that, the whole process. So we'll get some perspective from her about the criticality of due diligence and what's the best practices are there from diligence perspective. We also have Surekha Rao. She is co-founder of Triangulus, and she also is Triangulus is doing many things. Apart, one of the thing is about the due diligence of the startup. They also have a legal and financial and a business due diligence process. She herself is a accredited dispute resolution professional, and she has done a postgraduate in IP law from the National Law University. And then we have, last but not least, I think Jai. He's a founder and CEO of Triangulus. He comes with many years of experience in business consulting, commercial procurement, contract negotiations. He started his career with aerospace and aviation. He was part of ADA in the LCA project, and before that, he was in issue with ISRO. And he was fortunate to work with Dr. APJ Abdul Kalam also. So welcome all of you to this session, and hopefully we'll have a very interesting interaction and conversation around the due diligence process. No, so just to kickstart the process, Prachi, just tell about you. You just completed your funding round. How do you find what are the important factors for you to go for the funding? I think before we go into due diligence, I think it's very critical for startup to know when to go for funding and when not to go for funding. So if you can just share your thoughts around that.
Right. Thanks, Sanjay. That's a very important part actually to understand, because as important it is to get the money to grow your business, it is very important to time it so that you can utilize that money appropriately for your business. Because many times if we get into a wrong timing of raising the money and our product is not ready, or we are lost into not enough avenues to invest our money in, that can be very damaging for a good, successful or a startup which is on a way of a good successful company being in there. So the good part I would say is when to look for funding is first is, when you start a company, the product is very, very important. You have it in place. The idea is definitely there. After the idea is there, you made the product, and then you are ready to launch into the market to a level where you can accelerate the growth of that product and reach to a larger market scale. So to be able to accelerate that growth is when the funding is to be, timed. Many times, if we don't have a project or a business plan in mind and we raise too much money, that plenty of money being there and not being able to utilize can also be very, very difficult for startups. So yes, we should have a plan, we should have a product in place, and that is when you are ready to accelerate, that is when the funding should be in place.
Yeah, thanks, Prachi. And I would just add a two bit of from my experience. I think one is what you mentioned about it's from the growth perspective. I think when you need money to grow the company from 1x to 10x, and maybe you need money to grow it. But when not to do is, I think when you are in a survival mode and then you are spending money of and burning, and then you think that somehow you just justify the burning part of it, correct? That you say, okay, by burning, I need this funding. Even though you're not company is not growing. So that probably may not be the right way to approach from the funding perspective to investor. What do you think about that?
No, exactly. So just burning should not be the agenda. If I talk specifically about iExamB, we had been very, watchful on that aspect, and we've been very frugal on that aspect, that burning should not be the only agenda. But yes, it should not also be kept in mind that we will, so there's a balance you have to maintain between the growth and how much of burn that you are ready to take into account. It cannot be an endless spend on the marketing aspect that is happening, because many of the startups get caught up in that cycle where they are endlessly spending. The funding comes in, or we want a lot of funding for a lot of marketing budget. Marketing is important for the growth aspect, but it should not be to an extent where the product is not supporting enough, and it leads to a huge burn coming in for the company. So yes, the balance has to be maintained between what your growth has to be and where your product will be in line with the marketing expense to support that. So yes, endless burn will be very, very damaging for the startup.
Yeah, thanks, Prachi. So Surekha, if we look from the funding cycle perspective, maybe if you can just explain where does the due diligence fits into it, kind of thing, the whole process part of it.
Sanjay, let me answer this question by saying that, I want to take this opportunity and share it with these startups that what they do prior to a due diligence process is something that they should do it on an ongoing basis, right? When we do a due diligence, we look at broadly 5 categories. One is the incorporation related compliances. The other one is IP related, contracts, and HR related stuff. So what happens is when we do the due diligence, there are the companies start getting set things in place and try to undo a lot of things, try to bring in new compliances and things like that. Ideal way is to have a quarterly review, make sure that all your contracts are in place, legal risks are reduced, regulatory compliances are in place so that you avoid all kinds of penalties. Otherwise, you will end up paying penalties from the funds that you raise. So this is what we normally recommend to all our clients, that what you normally do during the due diligence process or prior to a DD process is something you need to follow as an ongoing practice and ensure that you are compliant every day, not just before DD. Sanjay, you're on mute.
Sorry. In terms of the process, I think it's when the startup gets the investor, and I would say that when they have the term sheet in hand, and now I think that after the term sheet, the due diligence process, that's when it kind of kicks in. And what you are suggesting is that if you are going for the funding, make sure that all the things are in place before you go for due diligence. And yes, we will discuss about the best practices part of it, and then how do we expedite the process, because those are all the critical things from the funding perspective also. So right, we will get into that more detail also. But Jay, I think it will be just interesting to know what magic you do during the DD process and what exactly happens and internally. It will be good to know from that perspective.
Thanks, Sanjay, and good morning and good evening to those in different parts of the world. We kickstart the due diligence process once either an investor who is investing in a company or a startup, or where the startup is keen on getting investments and wants a due diligence and proactively wants Triangulus, which is our entity, to kind of start due diligence and make it easier for investors to come in and invest in their company. So it's either the investors who reach out to us or it's the startups, and we have had engagements with both sides of the table. We kickstart once the arrangement is in place. We get the entire set of documentation from the startup. Now, when we say entire set of documentation, let's take a 5-year old company which is incorporated, let's say 5 years back. We need all compliances. So we start off from basic incorporation documents like the incorporation certificate, the MOA, the AOA, registration documents related to GST, PAN, TAN, shops and establishments, any trademark registrations. We look at statutory filings done over the last 5 years. We look at loans, advances, and outstanding liabilities, details of mortgage, and so on. We also look at investments, bank deposits, accounts, bank accounts in place, audited annual reports. financial business projections for the next 3 to 5 years is one of the key elements to kind of assess how the company is going to do financially. Now, all this is from a financial and regulatory due diligence perspective. From a legal due diligence perspective, we look at all regulatory compliances in terms of filings which have been done in let's say a board meeting or an AGM and so on, and get on to all documentation, which means any contract which is entered into with a client, a partner, a business partner, or a supplier or a service provider. We also do a deep dive into the appointment letters issued, which means the employment agreements, not just for the employees, but even the senior managers. And if so, the promoters of the startup are the CEO, the COO, and so on. We kind of see whether there are employment agreements in place. Sanjay, did I kind of dwell on all what is required to start the due diligence process, I suppose?
Yes. Yeah, I think I also wanted to just touch base on the myths, about the due diligence process. So if I look at from the startup perspective, as soon as we say due diligence process, I think they get worried, ye to exam kind of thing. Is that there is going to be a big audit is going to happen, and whether we'll get the funding or not. And from the investor's perspective, the myth is that, oh, this report doesn't tell me yes or no, should I invest or not kind of thing, no? So it'll be good to know from both of your perspective, and maybe from Prachi also from the startup perspective, about these myths and what are your thoughts around that, no?
Surekha, go ahead. So
Sanjay, from Triangular's point of view, there are certain ways in which we deal with the investment related issues. So for us, it's not an audit. The idea is not to find fault with the startup. And on the other hand, the idea is not to scare the investors by saying, look, you're investing in a company which is dangerous and deadly and nothing can be done. The whole idea and the entire approach that we follow is we want to make this deal happen. We want the funding to happen. And with that approach, with that in mind, we list out on what are the risks, we identify the risk, we assess the risks, and we kind of segregate it and put it in different buckets to say these are minor risk, high risk, medium risk. And then when the minute we identify the major risk, we get in touch with the startup and the founders and tell them, look, these are the risks and these are the mitigating measures. So what are you doing? Can you help us in resolving these issues? So what happens is, while the due diligence is in place, is in progress, the startups and, in collaboration with us, they try to reduce the risk. And investors are happy because we are ensuring that the risks are reduced. See, it doesn't make a sense that at the end of the DD, we give a big fat report and say, look, there are so many issues, don't invest. What we believe in is we tell you what the issues are, what are the ways to reduce the risk, and we make sure that the conditions precedent or condition subsequent in the shareholder agreement is not more than 3. Max is 5. So we try to resolve it during the due diligence process. Otherwise, it just becomes a formality to check the boxes and say, look, this company is not doing well, there are so many issues. Because we understand the startup perspective that it's not easy to be in compliance with so many things, regulatory, Companies Act, IP, and contracts. So we understand their point of view and we help them manage it.
So if I add here what Surekha has been saying, this was a very good point that she brought up, that we don't want to scare away the investors, and neither there is a reason to point out faults, because like Surekha was telling, it's many times the startup founders, it's of course many times, most of the times it's their first time getting into business at a company level. they are ignorant also of a lot of regulatory requirements that are there. So due diligence, I would say, also helps. Yes, Sanjay, like you mentioned, it's a myth, but yes, a lot of it happened with us also. It does scare. What will happen in due diligence? What will come out? But the intention is always right, both from the startup point of view and the agency who's doing the due diligence, that we just want to check what all things are there, what compliances are in place, and if they are not, what we can put in order. So I think the entire process also grows the organization, the startup, also in the phase like iXambi. I think we also have grown through this entire journey, trying to know what all is required, what are the different kind of compliances we should be carrying on an ongoing basis, and not just when the funding is required. So that was another point Surekha had mentioned, that we should be doing it on a quarterly and on an ongoing basis. So that becomes a practice then, and that's how the startup also evolves in their life, becoming bigger and bigger. So yes, it many times it looks scary, but that's how our learning has been, that we don't have to get scared. Intentions are right, we are in the right place, and this due diligence process helps us to put our things in order, our house in order, so that the next time anything is there, we're also more confident and more mature as an organization. So it's been helpful. The experience is not start at scare, but then you realize that it is important part, and it's not really as scary as what we had thought it would be.
Yeah. Jay, you want to mention anything?
No, I just wanted to kind of, Surekha did speak about the various levels of risk which we do an assessment on. So I thought it's an appropriate idea that we share one of those kind of risk assessment scorecards which we kind of provide as part of our due diligence process, and it's part of the executive summary which we provide. Is my screen visible to all, Sanjay and others, I suppose? So what
it's visible.
Yeah, what Surekha was mentioning is about the risk assessment scorecard. Now, Surekha did mention that we, at different stages of the due diligence process, give an assessment of the risk on each of these parameters which you see highlighted in the bottom, which means from a financial health perspective, from a credit history perspective, from a compliance perspective, from a litigation history perspective, from a legal perspective. So we have taken 5 sides of the company, we're looking at it from 5 different directions. How is the risk? And come up with an overall entity risk assessment. So we have an easy to kind of read when it comes to investors who don't have the time to kind of spend too much of deep dive into due diligence report. Incidentally, our due diligence report comes in 2 parts. So we have a part A which dwells on the legal due diligence, the part B which dwells on the financial and regulatory due diligence, and an executive summary where the risk assessment scorecard finds a place. We come up with an overall risk rating, which gives a flavor of the kind of risk, the assessment of risk in each of those different areas, and an overall entity risk. In this particular case, you would see agreements when contracts were not there in all places, which made in the legal parameter where we found agreements and risk a high risk item. Whereas when it came to litigation history, the startup did not have a litigation over the 5-year period where post incorporation. So we knew there was no concern. And so the risks are marked as no visible risk. There are certain financial issues where we found there was some low risk. So you have an overall assessment in 5 different dimensions for the startup. And finally, an investor looks at what is the entity risk, and that's what is presented here. So this risk assessment scorecard finds a place in the executive summary of the due diligence report. And that's something which we happily share to both sides of the table, which means We share the same report to the investors and share the same report to the startup company as well.
Yeah, this is fantastic framework. Yeah, also I will just look from the investor's perspective. So from investor perspective, investor understands, especially with early stage startup, that startup always have a resource constraint kind of thing. And in some cases, regulatory cases, knowledge deficit also, I would say, because startup would be focusing on their idea, they are passionate about their idea, and they want to work on their idea. So that is understood from the investor's perspective. It is more question is that if company grows tomorrow as a big company, that's why the investors are investing. Is companies aware about these challenges and what they are going to do with these challenges? So that's where I think willingness of management of the startups about understanding these issues and then saying what are the mitigation they're going to take, that becomes very, very critical from the investor perspective versus finding out those issues. I think finding out those issues is critical because that's where you know that where you are and what work you need to do kind of thing, no? So that's kind of from the investor perspective, I would say. I think we have started getting a lot of questions from viewers also. So the Vijay is asking that what is the informal due diligence and when it will start, no? So maybe I think you do startup perspective, Prachi, you do any informal due diligence before you get into the proper due diligence, or how does it work, no?
So informal due diligence, per se, it was mentioned that these aspects, we are also aware that legal due diligence is a part of it, your business and your financial things are. So putting things in order as per our understanding, that is always there. And it is, not just because of the investor money coming in, it has to be a practice overall. So keeping things as transparent as possible from day one. I think that is the part of the informal due diligence, keeping the, whatever regulatory aspects we have awareness about, taking help of CA and CS in that process, that is there. And then your financials, of course, again, putting things on paper as much as possible. If there are any gaps, we may get to know after a proper formal due diligence. But from our end, from a startup's end, always keeping things on paper in black and white, as much as transparently as possible. That I think journey should start from day one for any startup, because this makes the entire process easy when we get into a formal due diligence aspect.
Yeah, so I would say more than informal due diligence is like getting ready for due diligence.
Getting ready for due diligence,
yeah.
right?
And I think having that checklist, what all things will be required for due diligence. Obviously, there will be additional document will be required once they go through those first set of documents. But getting ready, I think the checklist is very, very critical. And if startup don't have checklist, it's very easy to get those checklists, and I think they can ask the due diligence consultant or the any of incubator, accelerator, or VC or angel network. I think all of them can provide that information to them, no? And then they get ready before they start that process. I think it'll be good to get ready before they go for the investment also. I think because that it takes some time to get all those documents also. And then if you start that after the investment process started, it may delay the whole process. Yeah.
Process.
So.
Sanjay, if they follow the process of quarterly review and ensure that they are in compliance on a regular basis, they are always DD ready. They don't need a checklist before the DD.
Yeah.
So that
Yeah, good point, Surekha.
is the ideal way of.
I think Surekha is on mute. Yeah, okay. So I think the next question probably, Jay, you have answered, but maybe you want to add anything. Do you have a framework for assessing compliance and regularity of startup through system, or it's a completely manual process?
No,
is there any automation? Is there? I think maybe that's a kind of framework. Yeah. You shared the framework part of it, yeah.
Yeah, so we do have a very clear process of due diligence. We have a sheet of a set of requirements which we send out immediately after the mandate is clear. We kind of send it out and get the startup company to provide the details as per a checklist which we provide. So we have two checklists, one which is related to legal compliance, one which is related to financial compliance. So the startup is clear of what is the requirement from day one. In most cases, connected to your early question, in most cases where the companies have our due diligence ready, they would have all the documentation ready. We set up a Google Drive. Its documents are sent across. There are folders which are named specifically to address each of those areas which we are going to review. There's a team of lawyers, financial experts who work on the due diligence process. There are folders where the startup provide the data, the bunch of due diligence experts review them. In Triangulus, Surekha and I monitor the review process. We kind of send back a bunch of gaps where there are, in case there are gaps, and then at stages where we find some kind of risk, we talk to the CEO of the startup, see whether those risks could be mitigated even before the end of the due diligence process. So there is, of course, an automated process where the due diligence kicks off. There's also an a process where we kind of go back and forth to kind of ensure most of the risks get mitigated, if possible, prior to even the completion of the due diligence.
So what you have is more of a process part of it than the automation part of it. I think it's a process which kind of drives the whole DD process.
Yeah, and to answer specifically that question, you need manual intervention in that sense, which means we essentially go through each of the documentation. So it's a detailed process in that sense. Yeah. You can't automate it. It's not just checking the boxes. We need to review every document which is on the folder manually to ensure that the compliance is, or else we are not doing our job effectively. Yeah. And the investor is actually looking at the due diligence report before he puts his money on the startup, with the startup, So yeah. It definitely cannot be automated in that sense.
Yeah, understood. So I think just a very fundamental question. What is the difference between legal due diligence and financial due diligence? What is the difference? And can you just elaborate further on that? No, because we keep hearing that legal diligence, financial due diligence. So how they are different from each other? Because for many people, financial due diligence also is some kind of regulatory compliance kind of thing. So if it will be good to just understand what differences that have, no?
Okay, I'll leave Surekha to answer the legal due diligence part, but from a financial due diligence part, it is more the, how the company has been managing its finances over the last years. Mm-hmm. Now, if we take an example of the same 5-year-old company, over the last 5 years, how has it performed from a financial perspective? Has it been compliant to all the regulatory statutory requirements in terms of its filings, its income tax, its GST? Has it been uploading its board minutes? Has it been keeping the ROC informed of any changes and so on? So that's essential. The remaining part of the financial due diligence is the forward-looking assessment of how the company plans to perform. What's its objective? What's its growth plan over the next 5 years? How does it look at its revenue and P&L over the next 5 years? What's its growth plan? What is its roadmap for the product or the service which they are taking? That's what is financial due diligence. Is one different dimension compared to legal due diligence, and I'll let Surekha answer that bit.
Thanks, Jay. So, Sanjay, when we talk about legal due diligence, what we try to do is identify the legal risk in all the transactions that the startup entered into. And it starts from the incorporation documents. So the basic one would be a founders agreement or a shareholders agreement between the promoters. It starts from there. There are regular compliances from a Companies Act point of view, filing with ROC, whether it is done. And then there are compliances from, Companies Act perspective, where board meetings have to be held, AGM have to be held in a certain manner. the minutes have to be filed and maintained in a certain fashion, whether those have been done properly or not. Then the contracts that the startup enters into, whether it is internally or with external agencies, with employees, whether the confidentiality is protected, how it is managed. What about the IP, whether they have an IP strategy to manage their IP, whether they have the registrations. And depending on which sector each of these startups are, there could be some regulatory requirements. For example, if it's a fintech company, then there are a lot of RBI related regulations that the company should be aware of. If it's insurance related, then there are IRDA related regulatory requirements. So each of these sector specific startups have certain compliances from that particular sector point of view. So we also look at that, whether any licenses have to be obtained, whether they have valid licenses, whether they have expired or still valid, and things like that. So these are the broad areas, but every activity of a startup, we review, analyze, and assess the legal risk. So that is broadly the legal due diligence for a startup.
Sure. Thanks, Surekha. I think there is a very interesting question which Kaushik has asked. Kaushik Panchapakeshan. I hope I pronounced that correctly. How much variation result of due diligence is acceptable? So it's like black and white. That's what we were earlier discussing. When you're saying this due diligence is a good for the startup is good or startup is bad kind of thing, no?
See, there are two aspects to it. When we do a due diligence, one, as Jay and I explained, the documentation part of it, but more importantly, the mindset of the promoters is of prime importance. See, when we interact with them, there have been instances when we ask for a founders agreement or a shareholders agreement, and we get a response that, oh, we are school buddies. So if this is the response we get, then there is a red flag. Right? Because if the startup is not able to comply with certain requirements due to bandwidth issue, or they are not aware, we help them get there. But if the mindset is to say ki we will manage if something goes wrong, then it's a problem, because there is a possibility that they will land up in trouble at some stage in the process.
Sure. Great. Prachi, you have any experience around this aspect of due diligence where you would have seen some examples if you have?
Yes, so like Surekha was mentioning, how much is acceptable and how much is not acceptable. I would also agree with the fact that the intention is very, very important. Right, so there have been instances with us also where the intention was that we were just ignorant. Okay, that this has to be signed, like simple HR policies or employment agreements. So there's one that there can be a structure and signed and all, and then we have been put in place that it should be stamped also. So that was something that we were not aware that it needs to be stamped and all, but the thing was in place. The document was there. So yes, I think intention is more, and the willingness to comply is much more important. So those deviations, why those deviations? Just having deviations, I think, is not important. That's also what we have seen. But why those deviations happened? And that becomes a critical factor and we have also seen that, when we were able to see if there were deviations, then why, if we were able to give a genuine reason why those deviations were there, and then a willingness to comply with that in future. So then it comes, like Surekha was mentioned, in conditions precedent or conditions subsequent. That is where the willingness to subsequently comply, if we find what the gaps are. So I think that helps a lot.
Yeah, so we will take those two jargons also, because many people may not be aware about it a little later. Yeah, but I think just continuing on this thought process is like, maybe Jay, what are the strong indicators from a strong management team is there? How do you evaluate their experience, skills? Means, do you do that part in due diligence? And if you do, how do you do that now?
Yes, Sanjay, I think a need for having a strong management in a startup is one of those essential things which we look at as part of the due diligence. Definitely, we need to have clarity in terms of whether the promoters, if the promoters are themselves part of the senior management, are they utilizing their individual skills and experience and taking up responsibilities? Are there very clear definitions and delegations of what each of those promoters are going to do? We look at the passion and enthusiasm which most of the senior management has. We definitely look at how the promoters are, what are their skills, their expertise, their ability to work together as a team, how well they kind of delegate and diversify and work on individual experiences and take up roles appropriately. So could be a gentleman or a lady who is a promoter and has a lot of technical experience, and the person, if he or she takes up a CTO role, which is more appropriate, somebody who is capable of getting investors in and managing the affairs of the company well, taking up a CEO role and so on. What we have seen from our experience in most startups is when there are issues, when there's lack of clarity in the promoters on the way forward, and that's a red flag when it comes to senior management. When we do our assessments as part of due diligence, invariably we find in such organizations, the promoters fall apart, and that's where the red flag is. So we really look at the senior management profiles. We also do an assessment and give the feedback to the investors. Obviously, it won't find a place in the due diligence report, but that's more informal input which we provide to the investors.
Yeah, no, I think this
you could call it
yeah,
part of the due diligence process or otherwise, but that's done in a very informal manner.
Yeah, so I think I've been a part of few due diligence process with Triangulus, and I find that some of those things also informally kind of, even though it's not part of a due diligence, during the process, if you find something, you don't want to just mention, okay, this is not part of the scope, let's not address it. At least inform that so that right people can address those issues also,
exactly.
which is
yeah, Sanjay, we go a step further. If the promoters are willing to listen, and that's happened in the case of Triangulus when we have done its due diligence, if the promoters are willing to kind of hear us out, we do openly kind of have the conversation with the promoters, indicating that these are the issues. We go a step further to say you need to have employment agreements, even though they are promoters, and clearly define roles and responsibilities of each of those individuals, have that executed as part of the due diligence process as conditions precedent, and ensure that's in place before the investor steps in and puts his money on the table.
Yeah. Yeah. So I think there is a question from Prashant Menon, and I think that kind of you already addressed it, but I just wanted to make sure that we covered that. How do you handle behavioral aspect of the core team, their attitude, soft skill, ability to carry on team, establish non-toxic working environment, etc.?
Yeah, I think Prashant's question was answered in a way. Yes, it's part of the due diligence process, not part of the formal due diligence process. Behavioral aspects are something which is not mandated in the DD process, but we do provide those inputs. And I think, Sanjay, you and Sand Angels are aware on most of the due diligences which we have done for you. We've kind of given you a feedback on the leadership team and how the promoters behavioral aspects. We have got some excellent startups as well, and where they have been very, very open, transparent, and so on.
Yeah, and Surekha, this next question from Anbarasan Subramanian, and probably it may cover some, if you can explain CPCS part of it also, no? Which will be the end result of due diligence, risk finding and mitigation measure, or a market value assessment?
I think it's a combination of both, right? We can't look at the funding transaction only from legal point of view, only from financial point of view, only from the product point of view. It has to be, it should have the right mix. So when you look at it holistically and then see whether it makes sense to invest in that? What are the risks? What are the business risks, financial risks, legal risks, regulatory risks? And then take a call. It's very difficult and not the right way to look at it separately and decide based on one individual factor. Because
Sanjay,
one may
just to
impact the other. Yeah, sorry, Jack, go ahead.
Yeah, no, just to kind of add on to what Surekha says, and probably, and I'm not doing a bit of marketing for Triangulis, probably that's where the combination of Surekha and I work well with startups who do due diligence, or for investors who want due diligence to be done to startups. Surekha is a hardcore legal professional, looks at it from a very legal point of view, looks at due diligence from that perspective. I bring in the business angle to the whole story and see whether it makes sense. Is there an opportunity there? Does the investor really going to make money at an exit point? Does it make sense in terms of financial, investment into the company and so on? So it's a holistic approach which we look at when we do the due diligence, and it's not black and white in that sense. It's not numbers alone.
You're on mute, Sanjay.
Yeah, just to complete that whole process from term sheet to due diligence, and then what happens end of due diligence, and that's kind of a question. So end of due diligence process, you get certain condition precedent, condition subsequent. What does that mean, kind of thing, correct? Condition precedent is something which is very, very critical, and you want to make sure that before the investor invests his money, those conditions are taken care of, kind of thing. That's called precedent condition, that before you invest money, that this condition needs to be taken care of, kind of thing. And condition subsequent is something which is still important. Still there is a risk is there, but it may need more time also to complete it. An investor understands that it becomes a part of the SHA, which is a shareholder agreements between the investors and the startup, where you put those documents there and say these are the things at certain time frame you need to make sure that you fulfill these conditions. No, and once the management team agrees that, then only the investor puts that money. No, so that's kind of end result of due diligence. Would you agree with that, Surekha, Jay?
Yeah, absolutely. And it's important that we have these two separately, because in most cases, conditions subsequent require some time to comply. And we don't want to delay the entire investment process just because, for example, any license has to be obtained and it takes 3 months. So if we put everything under condition precedent, which means the investor cannot invest, cannot sign the SHA till that is done. So when these kind of items which are more procedural and where the promoter commits that they will comply with it, is when we put that in condition subsequent. The very critical ones are which can be completed before the SHA is signed, fall under condition precedent.
Okay.
Sanjay, just to add to what Surekha said, what's important is that condition subsequent also needs a very clear timeline. In most cases, that's one which gets discussed extensively, I should say. I wouldn't use the word negotiated because that may not be an appropriate word to use, but that gets discussed at length between the startup, and
you have on mute, Jay.
Oh, sorry. And that's because what happens is invariably the startup needs the money immediately or at the earliest, whereas the investor sees a bit of a risk there. So we actually do a bit of a timeline assessment on, let's say, would 3 months be the appropriate timeline by which the condition subsequent can be covered, or would it require 6 months? And then it gets into a bit of a discussion to kind of firm up the timeline. It's essential, I would say, at this point of time. I know there are a lot of startup CEOs and founders on this call, a lot of promoters on the call. There is a lot of angel investors and other VC firms, chiefs of partners of VC firms on the call. So it's essential that we don't have a timeline more than 6 months. I'm not saying that's mandatory in that sense, but in most cases, we do not recommend more than a 6-month period when it comes to condition subsequent.
Great, Jay. Let me just put Prachi on the spot kind of thing. Prachi, what are your frustration with the due diligence process? I will share my frustration from the investor perspective, and then we'll ask Surekha and Jai how they balance it. No.
So it's the time. It is definitely a lengthy process. And yes, the long list of papers, of course. But I think for the first time, that's the frustration, because there's endless. It seems like an endless list of papers that have to be provided on an ongoing basis. But yes, once you cross that bridge for the first time, subsequently it will become easy. And as I was saying in the beginning, then your house gets into order. But putting the house into order can be very, very frustrating for sure.
Yeah. Ask the kid when he has put the house. We ask him to put a house in order. How frustrating for him it is.
Yes. So yes.
Yeah, that's true. Yeah, I think from investor perspective, if I would say that as what Prachi says is like. We start the due diligence process, and then we kind of tell the investors, okay, in a month time, keep your money ready, kind of thing, no? And the DD report is coming, and then and I think there's nothing wrong in that, because we are trying to find out more information about it. So I completely understand that is the process which needs to go through that, and it's a very important process from investor perspective. I think investor don't mind so much about the timing part of it, then the making sure that they get the good input from the DD report. No, I think that is more critical for them. Yeah, they feel sometimes that it's taking a long time, and some of that concerns don't come on the person who are doing due diligence, but it comes on the more startup side. And they say, why startup is not providing this information? I think that frustration builds from that perspective, kind of thing. But they do value that this needs to be done. So how do you balance those things? I think Surekha and Jai, maybe if you can just give what are the tips and how you balance this, both the requirements, no?
So Sanjay, it gets a little tricky for a firm who does the due diligence, because on one hand, we want to make sure the investors' interest and money is protected, safe. And on the other hand, we understand the difficulties that the startup and the promoters are going through in arranging the documents. And we are also under the pressure that, okay, when can you give the DD report? So that is a standard question that every call we have to answer on the timeline, right? So it gets really a little tricky. So what we normally do is we have the 5 parameters, as I had mentioned earlier. So we look at the major risk in all the 5 categories. One is the incorporation, licenses, IP, contracts, and HR related stuff. So when we identify major legal risk in all these, we work with the startup and the investors and try to mitigate the risk. So what happens is parallelly we are working on the minor risks also, which parallelly get addressed. If we wait till the end and list out all the major risk and minor risk in a report, which is say 100 pages, and give it to the startup, and then they start working on it to mitigate, it will take another 90 days for them to comply. So in order to reduce the timeline, we work parallelly with the investors, startup, and internally. Though it's a very hectic process, but I think this is the best way to complete the DD and ensure that we are not compromising on the quality in order to complete the DD on time.
Yeah, I just wanted to add, just to answer Prachi's question, if the house is in order and the documentation is shared with us, let's say in a matter of 3-4 days, the gap analysis in terms of what additional documentation is required comes to you quickly. Triangulus probably has been doing a lot of DDs in the past, and I think the time taken is anywhere close to a month, less than a month in certain cases. As Surekha said, we have a system of closed loop interaction, which means as soon as risk gets highlighted, it goes to both the startup, the promoters of the startup, as well as the investors, so that they are aware. If there is risk mitigation efforts in place, it makes the process much more easier that we are able to kind of clear most of the big red flags. And if in most cases from a financial, Surekha did touch upon the legal aspects, but on a financial angle, if regulatory compliances has been in place, all the filings, IT, GST, income tax and GST, and the ROC filings are in place, we kind of are relatively comfortable, since the roadmap to further growth and return on investment are things which the investors anyway looking at it. We feel from a financial angle, the startup is compliant, so the process is much faster and less frustrating in that sense.
Yeah. So maybe I think Jay and Surekha, from your experience, since you've done many of this due diligence process, what is the shortest time frame when you produce a DD report? No,
2 days.
2 days. Wow. That's amazing.
That was a quick one, small startup, and it had to be closed during the weekend. So Friday we were given the assignment, Monday we were ready with it. But of course, it was a very quick and small one, not a elaborate one.
So when you small means it's just started and then didn't have too many financial document, ROC documents and things like that, correct?
Yes.
Yeah. Typically, if you see that most of the startup, they will have about couple of years of ROC filings, correct? Most of them. So in those kind of scenario, what do you say is the minimum time which due diligence process will take? No.
See, it depends on when we get all the documents from them. See, if we get 100% documents on day one, within 20 days, we can close the DD process. But what happens is sometimes it goes back and forth and we have to wait for certain documents, then it gets pushed. So normally a month is what we normally take, but sometimes it gets pushed to 1.5 months, depending on how long the startup takes to give us the documents.
Yeah, average you will say about 1.5 to 2 months kind of thing, which in your experience, okay.
Yes.
So that's what the investors will say.
Yeah, Sanjay, I would like to kind of mention there, when you say 1.5 to 2 months, is where cases where the startups were not ready with the entire documentation. Okay. In cases where documents were ready, and you're talking about, let's say, 4-5 years of post incorporation where the funding is coming in, I think what we have taken is 20 days to a month from the day all the documents have been available.
Okay.
Let me put the caveat and then say that. So from the day when all documents are ready, I think 20 days to 1 month is something which we can see.
Yeah. The follow-up question, Jay, on that would be, how many startups have all the documents ready? No.
Not everybody. So that's always the issue, Sanjay, and we don't find anything wrong with it. Now, if everybody was in the most ideal situation, then I think Surekha and I'll be out of our jobs, because we don't have any due diligence to be done. So yes, startups do have concerns. It's because of various reasons. It's two good friends, classmates, batchmates, college mates, came out of IIT together, starting up, great idea, doing well. They kind of miss out on the non-core area. So I'll go back to the statement which Surekha made at the start of this call. In most cases, they miss out the fact that, yes, we are running a professional organization which has to have certain processes in place. And those are sometimes which get missed out. But I think we should also admit that most of the startup due diligences which we have done, the founders or the promoters have been good enough to kind of accept that there is a gap, willing to kind of close the gaps. There have been cases where Triangulus has worked with these startups post the investor funding to kind of get some of the processes in place as well. So it's not wrong to say that everything should be in place always. There would be gaps, and that's where we kind of do that analysis, assessment, and so on.
Yeah, thanks. So I think
we see a improvement in every round of funding. The first round, DD takes a longer time because they are not ready. Second round, they are much better. Third round, even better. So with multiple rounds of funding, startups get there.
Well, that's a very good point, I think, Surekha. It kind of shows the maturity of the startup also.
Yes.
So We have a couple of questions. I think we answered most of them, but let me just go through that, make sure that we are not missed out on that. Yeah, Jairam Nageshwaran has said, how long is the due diligence? Can you really spend team spend 1 month in startup, open to all meetings, discussion? Will this help? I think you answered that elaborately about the process part of it, and maybe I think Prachi, it will be good from your perspective. How much time the startup founders spend when the DD process is going on, no, compared to the business, no?
Yes, so in fact, I was thinking on that point, Sanjay, when you had asked about the frustrating point, because yes, a lot of time does go into, especially when it's happening for the first time. Like Surekha also mentioned, it gets better. So it's a learning curve for the promoters also from that point of view. So I would say typically, in the first time when things does come in place, 50% approximately time would have gone, but it started getting better with once we got to know the type of documents that are being asked, and what is actually the intention behind, and what is all that is being checked. Then it becomes better over the time. But yes, initially for the first time, a substantial part does go. So that's why also we are more interested that it closes as soon as possible, not because we are irritated because of just the documents that are being asked, but because we want to concentrate on the business aspect and don't want to lose that time out. So
good point.
Yes.
Yeah. So I think a couple of other questions, most of them we have answered, but let's go through that. And I do want to ask last one question before we close the call. No? Srijita Ghosh has said, what are some of the best practice you recommend for putting together data from the early stage startup? I think you did mention about it, checklist, and then ROC documents and quarterly. If you put it, then I think everything is be fine. Anbarasan Subramanian is put, apart from the compliance, are any other metrics you do for new due diligence, no? So I think you did mention about that startup founders, management team, and those aspects. So anything else you want to add, Jay, apart from the startup founders, management skills perspective?
In addition to the promoters and aspects which we discussed earlier on the call, we also do an assessment, though not part of a due diligence mandate. We just look at what's the product or the service offering which the startup is working on. How does it kind of fit into the market? Are there competitor products in the market? How are those competitor products doing in the market? Is there something unique? Is there a unique selling point, a USP for this startup? Something different which the current players in the market are not offering. Those are some of the things which definitely we feel the investors are looking at before they put their money in. But we as a due diligence team look at it. If we find some issues, we do raise those. Again, it's part of an informal due diligence process. We do come up and talk to investors saying, are you sure this makes economic sense? Is their product good? And so on. I think, excuse me for that.
Bless you.
I think those are those aspects we do look at it from a market point of view, whether it makes sense.
Yeah,
Surekha, you want to add something?
Yeah, Surekha.
No, Jay, I think you have pretty much covered earlier and now in detail. So
Sure. So just the last 1 minute, and I want to ask this question is, please share any horror stories which we have from a due diligence perspective, before we close the call.
We've had a couple of stories, horror stories, but I think I wouldn't call it a horror story. Maybe it has to be reworded as a story. I mean, they landed into this trouble because of over enthusiasm. We have seen investors, they are so much excited to put in the money that they don't sign the SHA and invest the money. And there is some issue or difference between the promoters and the investors, and the deal drops out. And then the investor is not able to get the money back. Similar is the enthusiasm between the promoters, that they don't have an agreement in place. And then over a period of time, there is some difference of opinion. they part ways and the company collapses because they don't know how to manage it, because there is no documentation, no rights and obligations clearly defined and things like that. We have seen situations where the promoters brings in a friend or a relative, and again, due to over enthusiasm, commits some amount of share allotment to that individual, and he or she comes in as a consultant for providing either funding support, marketing support, or whatever. And when the promoter is holding 100% share, they feel 10-12% is very small. And they commit in writing, I will give you 12%. But there is no clarity on what services this individual is going to provide. And when actually investors try to put in money, they question, I am bringing in X lakhs and I'm getting only 6%. And why somebody is getting 12% for doing nothing, bringing in no money. And then the fight starts. And once the shares have been allotted, it's not possible to just withdraw. It's a long, complicated process. So I think the over enthusiasm and a lot of trust and lack of awareness on the regulatory and legal risk is where we have seen some of these. And whatever I explained is something we have actually experienced with some of our clients.
Yeah, and some of those I know about it. So yeah. Thanks for it.
The one which stands out, Sanjay, was where senior college mate was brought in. He was issued shares. He was made the director. He started a competitive another company which had a competitive product, and there was a lot of issue because he was a shareholder, he was a director, and it was a difficult situation. So that's the one which actually stands out among the bunch of things which Surekha said. And all these are live examples of what we have gone through in our journey of due diligence over the years.
Yeah. Thanks, Jay, Surekha, and Prachi for making this session very, very informative. And I'm sure that our viewers would have gained a lot of information, insight on how the whole DD process works. No, thanks a lot, and good night.
Thanks, Sanjay.
Thank you. Thanks, Sanjay. Thanks, Prachi.